You take the trade, the screen goes red, the P&L ticks down, and your heart does that quick, hollow beat that tells you you're about to make the next mistake. Pause there. Look at the chart, the candle that just ate your stop, the chat ping you didn't need, the coffee gone cold on the desk. This is the trap I want to fix today, and you'll leave with a short, enforceable routine that keeps you in the market without turning one loss into a week of poor decisions. Start with a quick definition so we use the same language. R is your defined risk per trade, the amount you lose if your stop hits. VWAP is the volume-weighted average price for the session. Cumulative delta, or KIM delta, is the net signed volume flow that helps show whether buying or selling pressure dominates. I'll use those and then move on. The immediate problem is simple and universal. A bad trade triggers a short, high-intensive emotional loop. Adrenaline, desire to fix, loss aversion, and that loop tends to override rules, increase size, and lead to off-plan entries that compound losses. The stakes aren't just the next trade, they're the integrity of your process. If you let a single reactive impulse redefine your size and rules, you can turn a 1R loss into a multi-R drawdown over a session. I'd rather miss the first 0.5R than donate 2R to noise. That's an opinion framed as a rule you can test against your own books. Mechanically, this happens because intermittent reinforcement rewards the occasional lucky revenge attempt, because novelty-seeking lubricates breakage of written rules, and because your physiology, elevated heart rate, narrowed attention, tunnel vision, makes you poor at probabilistic thinking for several minutes after a loss. You don't need convincing biology or long papers. You need a structure that treats emotional heat like adverse weather. You plan around it. So here's the playbook, concrete and enforceable, no fluff. First, pre-trade branches. Before you take any trade, write the best case, worst case, and most likely scenarios in a single line: entry, stop, target, and what you will do if the trade moves against you by 0.5R. If the worst case is a loss you can stomach, then proceed. If not, then don't. Second, hard size caps tied to status. Baseline size equals 1 unit of R. Off-plan impulses and revenge attempts are capped at less than 0.25R until you pass a short reset protocol. If you break the rule and trade off-plan, then your cool-off activates, a minimum 30-minute platform lockout, or until you satisfy 2 re-entry checks, an emotional check and a market data check. The emotional check is simple. You must have a 10-minute breathing period, get heart rate down, or roughly feel calm enough to read price objectively, and answer a short journal prompt: why did I take the last trade? The market data check requires one of the measurable conditions below to be met: either 2 5-minute closes past VWAP with rising cumulative delta and session volume greater than 1.2 times baseline, or a trendline break plus clean retest plus higher low on the 5-minute, or 2 consecutive range breaks with session volume greater than 1.2 times baseline, or cross-asset confirmation, where ES and sector breadth show greater than 70% advancing. If none of those objective triggers appear, you do not re-enter at baseline size. If the trade is off-plan and you insist on acting, you may only use the off-plan impulse cap of less than or equal to 0.25R and must log the reason. Log it. Third, timers and gates. After any single trade loss of greater than or equal to 1R, impose a 30-minute cooldown. After 2 losses of greater than or equal to 1R in a session, impose a full session lockout unless you can demonstrate 3 straight process-compliant setups flagged in your journal as #ASetup that meet the measurable triggers. If you break size rules, you must remain out for at least the next full hour and then pass the 2 re-entry checks. Fourth,
a kill switch for the day. If your off-plan incidence hits 3 in a day, or your rule compliance rate falls under 80% on process metrics, stop trading for the day and run a 15-minute audit of tags #offplan, #sizebreak, and #tilt before considering another trade. These are strict but simple rules. If X, then Y. If you break size rules, then take the prescribed timeout. If the timeout passes and conditions are met, then you may resume baseline sizing.
Now the practical checklist you'll carry physically or as an immutable overlay. Before entry, confirm entry criteria, stop, target, and pre-trade branch. Confirm the market data trigger, pick one of the concrete triggers above and quantify it. Confirm size equals baseline unless you're in a reduced size drill. Set a post-trade timer for 2 minutes to watch immediate behavior. After any loss, start the cool-off timer. Wait, breathe, check size. These are short commands because long rules fail in heat. A couple of concrete rules you can paste into your platform settings. Auto-block all market orders if session volatility, measured as ATR times factor, exceeds your tolerance. A soft alarm that locks you out for 30 minutes after any trade where you increased size greater than 20% above baseline without a pre-trade note, and an automated reminder that pops if you place a trade during a declared cool-off window. Discipline is about designing friction where friction helps. Let me give you a time-stamped mini case, so this is an abstract. NQ, midweek, 10:17 a.m., 2 5-minute closes above VWAP, cumulative delta rising, session volume 1.35x baseline. I took a base size scalp at the breakout with 0.5R stop and a 1R target. Price moved plus 0.5R in 6 minutes. I held base size until my trailing rule required partial scaling at 2 closes below the 1-minute HL and a fading cum delta. That day, the re-entry checks validated the setup, and I avoided the urge to add size after the first small win. That's the tidy case. Now, a messy one, because you need to see the human side. Once I felt the cold draft in the trading room, smelled the burnt toast from the kitchen, my fingers jittered and I clicked the wrong size, adding 0.5R accidentally on a thin tape while still breathing fast. I noticed immediately, closed the extra leg, and then enforced the 30-minute lockout. It was small, stupid, and correctable, and yes, I logged it under #sizebreak. You will screw up. Expect it. Design for it. The drills you'll run weekly embed those expectations into muscle memory. Drill 1, a 7-session feed audit. Over 7 trading days, spend the first 15 minutes reviewing your journal tags, #ASEP, #falsepause, #offplan, sizebreak, tilt, and calculate rule compliance percentage. Aim to improve compliance by 10 percentage points over the 7 days. Drill 2, a silent platform block. 1 afternoon session per week where you only watch charts, set alarms, and do not place orders. This trains your tolerance for waiting and reduces the itch to act. Drill 3, a blind entry pre-commit exercise. Before the session, pick 3 potential setups. Write the exact entry, stop, target, and size on paper, and don't view the live quote until at least one measurable trigger is present. Then you either execute exactly as written or you withhold entirely. These 3 drills are short, repeatable, and shift the decision from emotion to process. Now address the trade-offs and the rare exceptions, because discipline trades off missing early moves to preserve expectancy. You will miss the first leg of some high-quality moves, and that's acceptable if you keep your edge intact. I'll show a counterexample. During a sudden economic surprise, rare high-velocity event, the market may gap and run without standard confirmations. In that case, a permitted exception can let you take a small scaled entry only if A, cross-asset breadth exceeds 85% advancing, B, session volume is greater than 2.5 times baseline, and C, you limit size to 0.5R and take profit quickly at 0.5R.
This is not a license to gamble, it's a documented exception with extra checks. If you want one hard-edged rule as a compass, here it is. If you trade under emotional heat without meeting at least one measurable trigger, then you must limit any entry to less than 0.25 R and log the incident under #offplan. If you break that, you enact the kill switch for the session. The implementation detail most people skip is the re-entry script. Rehearse it. The re-entry script is: stop the screen, step away for 10 minutes, write one sentence explaining the last decision, check for one of the measurable market triggers, confirm baseline size, set a 5-minute post-trade observation timer. If at any point your answer is shaky, then don't re-enter. If X, then Y. Keep this short. The journaling language matters. Use tags liberally and quantify. When you take a trade, tag it immediately. #ASetup if it met objective triggers, #falsepop if it broke down without further confirmation, #offplan when it's a deviation, #sizebreak when size rules break, #tilt for emotional entries. Over time, these tags teach patterns. You're training a habit loop out of your ledger. The mental model is simple. Treat heat like noise and design gates that require verifiable evidence to re-engage at full size. One practical composition of evidence is 2 independent checks, a market state check and a physiology check. For example, 2 5-minute closes past VWAP with rising cumulative delta plus a calm 10-minute breathing period equals permission to return to baseline size. If either is missing, you stay in reduced size or out. Practice this until the decision feels like a habit, not an argument. Now, a short operational test you can run tomorrow. Set your platform to cap off-plan orders at 0.25 R. For 7 sessions, run only A setups at baseline size, unless the reduced size cap triggers. Measure how many off-plan attempts you'd have made without the cap. That feed audit will reveal how much your impulses cost you. Teach your body to tolerate the discomfort of missing a move. Repeat: wait, breathe, check size. When you scale winners, use concrete trailing logic tied to market structure. Trail to prior 5-minute higher low only after 2 closes past VWAP with rising cum gauta, or after 2 consecutive range breaks with session volume greater than 1.2 times baseline. Do not trail purely to price ticks. This preserves RR integrity and reduces early profit-taking driven by fear. One synthesis sentence. When you build re-entry rules that require both physiological cooldown and measurable market evidence, you create a repeatable boundary that shields your equity curve from emotional outsized swings while still allowing disciplined engagement in clear, validated setups. A second, longer synthesis sentence. The disciplined trader designs procedural friction, timers, size caps, kill switches, and journal tags that convert subjective urges into objective checkpoints, thereby turning episodic emotional noise into data that can be audited, coached, and improved over time. You'll want a short exception policy for that rare moment when the tape moves faster than your rules. Document it, quantify it, and make the exception stricter than the rule it replaces. Smaller size, higher volume threshold, and immediate partial profit taking. Implementation. Add a platform-level instruction that rejects market orders during cool-off windows, set visual reminders for the 30-minute lockout, create a one-click journal entry template that captures trade reason and tags, and schedule the 7-session feed audit on your calendar. On discipline tests after wins, a mirror rule applies. After a winning streak of 3 or more net positive trades, cap size at baseline and force a size review. No discretionary increases above 25% without a written size change justification. This prevents overconfidence and size creep. You'll measure progress with process metrics, not P&L, until your sample grows large enough to show real change. Percent rule compliance, off-plan incidents per week, and average size versus baseline. Expect small regressions, that's normal. One trade-off example to internalize. Sometimes you miss a swift breakout because you respected the 2 5-minute closes past VWAP requirement, and a friend made the same move and posted a quick win. That sting is a feature, not a bug. You preserved edge over many trials by avoiding noise. The final practical bit, a rapid mid-session recommitment script. Pause for one breath. Read the day's pre-trade branches, confirm tags and sizes, and say to yourself, out loud if needed, I trade the plan. That phrase anchors identity. A harmless imperfection here, you'll find yourself muttering it half the time. We all do. Close with the cultural habit. Make the cooldown real and measurable, keep a consistent tagging system, practice the drills, and review the 7-session audit religiously. Your market access doesn't vanish when you cool off, it becomes disciplined. If you enforce the cool-off with size caps, timers, and 2-fold re-entry evidence, then you will trade more often from choice than from reaction, which is the core of sustainable decision-making. The market is neutral. Follow the plan.